Okay, so you're trying to keep up with the financial world, right? But it feels like you're just buried under earnings calls, these super dense press releases.
Yeah, endless reports full of jargon. It's a lot.
It really is. You want to know what's going on, but who actually has the bandwidth to wade through all that stuff to figure out the real story?
That's a common headache for sure.
Hmm.
I mean, companies put out this mountain of data and pulling out what really matters.
Yeah.
The strategic shifts, the actual health of the business.
Yeah.
It takes time and a careful eye.
Exactly. And that's pretty much why we're doing this deep dive. We're aiming to cut through all that noise. We want to give you the core story from SEI's recent Q2 2025 results.
Hmm.
We've gone through their earnings call, the press release, pulled out the key stuff. Our mission today is basically to give you a shortcut, help you grasp what's happening with this pretty major player in financial services.
And for SEI this quarter, it wasn't just about the numbers on a page. It was clearly marked by, well, what they called strategic momentum. Plus, some pretty significant investments looking ahead.
Right, a clear vision for long-term growth seemed to be the theme.
Definitely. So the big question we're kind of asking here is SEI just reacting to the market, or are they actually trying to, reshape things in wealth management?
Okay, let's unpack that. Let's start at the top. SEI CEO Ryan Hick, he gave a high-level view, right? He seemed to emphasize strategic momentum, but also being upfront about successes and opportunities.
Yeah, exactly. And what was really interesting is how he kicked things off. He immediately jumped to a huge strategic move, SEI's big investment in Stratos.
Stratos, okay, tell us about them.
Well, he described Stratos as a real leader in the independent advisor space. They're known for strong organic growth. They're good at recruiting advisors. They focus heavily on the client experience and apparently have a solid M&A track record, too.
Okay, so a successful player in their own right. Why is SEI investing? What makes this partnership so important for SEI specifically?
Well, connecting the dots here, this isn't just SEI buying another company. It's more strategic. The idea is to integrate Stratos's, client-first model with SEI's tech, their custody services, their investment management stuff.
Okay.
The goal, as they put it, is to create a really powerful platform for advisors, especially now when the wealth management world is changing so fast.
Makes sense.
SEI said point blank, they think this move positions them to capture long-term shareholder value. Basically, by meeting that growing demand for more comprehensive, advice-focused solutions.
Right.
And there's another angle, too. It helps SEI innovate because they get direct insights into what end investors actually need. That feedback loop can then help their other clients, advisors, banks, investment managers globally.
So it's less about just grabbing assets, more about strategic fit and learning from the market directly. I
Yeah.
did notice they really stress the cultural fit with Stratus leadership. That's not always front and center in these deals, is it?
It's not, no. And that emphasis, I think, points to a longer-term view. It's not just about hitting next quarter's numbers,
Yeah.
which brings up a really important point. What exactly is SEI trying to achieve with Stratos? Because, the default assumption is always synergies, right?
Hmm.
Cost-cutting, combining back offices.
Standard M&A playbook stuff.
Exactly. But the sources, the call, the release,
Mm.
they make it pretty clear that's not the focus here.
Okay, that's crucial. So they're not looking to mess with Stratus's current growth. What was it, 10% organic growth?
Right, they don't want to disrupt that. Instead, SEI's plan is to augment Stratos's platform
Mm.
to support their ongoing M&A strategy. They've even earmarked tens of millions in future funding just for that.
Hmm. Interesting. So if traditional M&A often goes for cost cuts, what are the sort of challenges or maybe opportunities with this augmentation approach SEI is taking? How does that change how you measure success?
That's a great question. The opportunity is huge, right? You take Stratos's already strong growth and you turbocharge it with SEI's deeper pockets in tech infrastructure.
Yeah.
You don't try to fold them into the mothership. The challenge, though, is making sure that extra funding in tech actually enhances Stratos's model without accidentally, killing the entrepreneurial vibe that made them successful in the first place.
Right, a delicate balance.
Definitely. Success here won't be about cost savings. It'll be about Stratos growing even faster, using SEI's resources to scale up effectively.
Enabling and enhancing, not absorbing and standardizing.
Right.
Okay. And this focus on strategic positioning, it wasn't just external with Stratus, right? They made moves internally too.
That's right. Speaking of leadership strength, SEI also brought in two new independent directors for their board, Karen Reese and Tom Merrill.
Okay, Vanguard and UBS backgrounds. That sounds like a big deal. What does bringing them in signal about SEI's direction? What capabilities are they adding?
Well, Karen Reese, she used to lead Vanguard's huge personal investor and wealth management divisions, like $2.5 trillion huge. And she was instrumental in launching their hybrid advisory platform.
Wow.
And Tom Merrill, he led UBS's global wealth management business. We're talking over $2.8 trillion in assets there. So bringing them on board, it clearly signals SEI is serious about long-term growth, innovation, and accountability, especially in that high net worth advisory space.
Right, aligning with the Stratos move, perhaps.
Exactly. Their combined experience is going to be incredibly valuable as SEI navigates this changing landscape and tries to execute these growth plans, especially with the Stratos partnership now in the mix.
Okay, so we've got the big strategic picture, Stratos' new leadership, but, how did all this translate into the actual numbers? Let's drill down into the Q2 2025 financials compared to last year.
Right, the bottom line. So looking at the consolidated results, diluted earnings per share, EPS, came in at $1.78. That's a whopping 70% increase compared to Q2 last year.
70%. Wow.
Yeah. Revenue was up 8%, hitting almost $560 million. Operating income grew 9% to nearly $150 million. And their operating margin was 27%. That's a bit better than last year, but actually down a bit from Q1 of this year.
Okay, that $1.78 EPS sounds amazing. But is there more to that number? Any nuances we should know?
Yes. That's a really critical point. That
Yeah.
$1.78 EPS number, it included a pretty significant $1.76 in benefit from one-time items.
60 cents. Okay, what were they?
Mostly a big gain, $94.4 million,
Okay.
from selling their family office services business. Plus, there was another gain from sorting out a deal with a longtime vendor.
Got it.
Now, those were offset slightly by about 0 to 2 from things like foreign currency losses and, interestingly, legal fees tied to the Stratos investment. But the main story is the big one-time gain.
So if you strip those out,
Right. If you exclude those one-off boosts and the small offsets, the sort of core EPS from ongoing operations looks more like $1.12.
okay, $1.12 versus $1.78. That's a big difference.
It is. It tells you that while the company's definitely profitable, that huge headline jump isn't purely from running the day-to-day business better this quarter. It suggests maybe a strategic choice. Well, it looks like SEI is using these opportunistic gains, like the business sale, to maybe help fund future growth and repositioning like Stratos, rather than it signaling some massive improvement in core efficiency just yet. It feels like a calculated use of that extra cash.
That puts it into perspective, yeah. Okay, beyond the profit numbers, what about growth? Sales momentum, pipelines. Are they bringing in new business?
Yes, definitely some positive signs there. They booked nearly $30 million in net sales events just in Q2, and that pushed their trailing 12-month total to a new record, over $160 million.
Okay, a record. Where's that strength coming from mainly? Across all their segments?
The investment manager segment was called out as having strong momentum, but they said pipelines looked healthy across the board, private banking, asset management too.
And what about actual money coming in or going out, asset flows?
So that was another bright spot, actually, a
Wow.
big improvement for their advisor and institutional businesses. Think about this. First half of 2024, they had over $7 billion in net outflows.
Oh.
Yeah. First half of this year, 2025, just over $1 billion in net outflows.
Yeah.
That's a huge swing, a massive improvement in keeping client assets.
That is a significant turnaround. Okay, and overall assets, what did they end the quarter with?
As of June 30th, SCI had about $517 billion in assets under management, AUM, the stuff they manage directly, and then over $1.1 trillion in assets under administration, AUA, where they handle the tech or admin side.
Okay.
So add it all up, you're looking at roughly $1.7 trillion in assets that SCI either manages, advises on, or administers. It's a huge footprint.
Definitely a major player. Okay, let's zoom in on the specific business segments. You mentioned investment managers had strong momentum.
Yeah, they did well. 8% revenue growth, 7% operating profit growth. And that was really boosted by double-digit growth in alternatives.
Alternatives are hot right now.
They really are. And SEI said their pipeline there is extremely strong. They're seeing a lot of big alternative managers thinking about outsourcing operations for the first time. That's a key growth area for SEI, for sure.
Okay. What about private banking? You mentioned earlier they had some temporary delays. That caught my ear.
Right. So private banking grew revenue 7% and operating profit 11%, which is solid. Those temporary delays in sales events, about $2 million worth, they mostly blamed on market jitters back in April.
Oh, okay. Volatility.
Yeah. But they stress the pipeline is still strong and it's balanced across different sizes of banks. So it sounds more like a timing thing than a sign of weakening demand.
Got it. Now, investment advisors, that segment seemed like a real standout this quarter.
It absolutely was. Really impressive numbers. 14% revenue growth, 19% operating profit growth.
Wow.
And a big chunk of that came from their integrated cash program. That contributed $21 million, which was up $11 million just from Q2 last year.
Okay, so what's driving that and what's their strategy in that advisor space?
Well, they specifically talked about a strategic shift. They're going upstream, as they put it,
Yeah.
trying to work with larger advisory firms and really grow their RIA business.
RIA being registered investment advisor.
Exactly, a key part of that independent advisor world. And to do that, they're shifting resources away from traditional mutual funds and towards things like tax-sensitive ETFs, SMAs, and models.
ETFs, exchange traded funds, SMAs, separately managed accounts.
Right. Those are super popular now, especially with wealthier clients, because they often give you better tax treatment and more customization compared to old-school mutual funds. So it's a clear strategy to capture that growing, more sophisticated end of the market.
Makes sense. Okay, quickly, what about the institutional investors segment?
That one was a bit more mixed. Revenue was actually down 3%, but operating profit did nudge up 1%. It suggests maybe a more stable, mature part of their business compared to, say, the high growth we just saw in investment advisors.
Okay. Now, we touched on the overall operating margin dipping a bit from Q1 to Q2, down to 27%. Let's dig into why that happened. What's behind that sequential dip?
Yeah, they were pretty clear about this. They said it reflects intentional investments. They're actively spending more on talent, on technology, on their platforms.
Okay. Investing for the future, then.
It's exactly. It's about supporting future growth and making sure they can execute flawlessly as they bring on new business. For example, they mention hiring people before expected new deals close in investment managers, and they're putting money into tech to streamline systems, make things more scalable, more cost-efficient down the road.
So, spending money now to make money or handle more business later, not necessarily a sign of inefficiency creeping in.
Precisely. It's a deliberate choice, but of course, you have to make sure those investments actually pay off, right?
Right. What did they say about that, ensuring they get a return?
They talked about being surgical with hiring very targeted additions, also reprioritizing discretionary spending, cutting back where it makes sense, and streamlining internal processes. But crucially, they paired this with talk of increased accountability,
Meaning?
meaning they expect to see results from these investments. It's a long-term strategic play, yes, but one that requires discipline and, well, accountability to actually deliver the expected benefits.
Okay, that makes sense. It sets up the road ahead nicely. What's the big picture long-term focus for SEI, especially with all these moves we've discussed?
Ryan Hike said it pretty directly. He stated they're committed to running the company to make sure SEI endures and thrives for the long term, not just quarter over quarter. That long view really seems to underpin these big investments and strategic shifts.
And competitively, how do they see themselves fitting into the market as it changes? What's the opportunity?
They seem to feel the landscape is actually shifting towards them. They're seeing more interest in outsourcing from banks, from big RIAs, from those alternative asset managers we talked about, organizations that maybe used to do everything in-house.
Right.
SEI thinks its wide range of services puts it in a unique spot to help these firms transform their operations and capture that growing demand.
Okay, so if that's the strategy, investing, positioning for outsourcing, what does that mean for how they use their cash? Capital allocation. Balancing investing versus returning money to shareholders.
They seem to have a pretty disciplined approach. On one hand, they've returned a lot of capital to shareholders, over $700 million in share buybacks over the last year, plus dividends.
Significant return.
Definitely. But then the Stratos investment, as we talked about, that's being funded mainly with cash they already have on the balance sheet, probably low-cost cash. And importantly, they said they still have capacity for more investments, including those tens of millions earmarked for future Stratos M&A.
So a balanced approach. Return capital, but keep dry powder for strategic moves.
Seems to be the plan. Very deliberate.
And if you, our listener, want to get an even deeper look into their strategy.
Yeah, they're actually hosting an Investor Day. It's in New York on September 18th. They plan to really dive into their strategic priorities and what they expect the outcomes to be. So more detail to come there.
Okay, so let's try and wrap this up. To recap our deep dive, SCI turned in a financially strong quarter. The headline EPS number was boosted quite a bit by some one-time gains from selling a business.
Right. The underlying $1.12 EPS is maybe more indicative of core operations.
But still, solid core performance underneath. And strategically, some really big moves. The Stratos investment signals a major push into the independent advisor space, focusing on augmentation, not just synergy.
Plus strengthening the board with heavy hitters from Vanguard and UBS.
And making these very deliberate, forward-looking investments in tech and talent, even if it temporarily dips the margin slightly, it all seems geared towards setting the stage for future growth.
Absolutely. It feels like a company really trying to position itself not just for the next year, but for the long haul in a financial services industry that's, well, changing incredibly quickly. They seem to want to actively shape how wealth management and advisory services are delivered.
Which brings us to a final thought for you, the listener, to chew on. Given everything we've talked about, SEI's focus on these big outsourcing partnerships, the evolving advisor models like with Stratos, how might these kinds of trends reshape the future of financial advice and wealth management for your own financial life?
Yeah, whether you're an advisor trying to navigate these changes yourself, or an investor deciding where your money should go, or even just someone trying to stay informed, what do these shifts, these big strategic bets by companies like SEI actually mean for you and your planning?
Something to think about.